Oh, hello. Welcome to Pro Trader Strategies. My name is Eric Wilkinson, and this is your guide to cracking the code to trading options. I just noticed it looks like I popped in here about 10 minutes early. I thought my clock said 1:15 and it actually says 1:05. Sorry about that. Bit of a crazy close though, huh? That's what I got fired up and jumped in here, and it obviously was a little bit early. So sorry about that. Some of you folks that are trying to catch up, I will circle back around for you folks that are watching this a little bit delayed for the actual start time being 10 minutes away. So I will keep an eye out there, making sure everybody's clear concept on the questions over in the comments section. So make sure you guys are jumping on that. I want to make sure you're clear concept. And don't forget to smash the like button before you go. Especially if you get that light bulb moment, which I'm sure I'm going to be able to provide for you. All right. So when you get that light bulb, smash the like button for me. All right. Let's get on with it. This is the options guide. Like I said, we're going to be cracking the code to trading options. And I'm going to try and break it down for you guys. What I like to do in my webinars is start from simple concepts and build the real life examples. And we'll do that throughout this video. I'll break it down to something that we can relate to, and then we'll put it into those options that are sometimes a little bit scary for some people. But I'm going to lift the veil off of that for you. All right, we are going to be doing the synthetic short. I don't know why that says long. It should be a short. Let me just make sure I mark that up so everybody realizes that this is wrong. I'm going for the synthetic short this time. So short. We did long last time. So if you missed the long, this is going to be on the short. So we're going to be looking for bearish type of moves. All right. Last week we did the longs. Now we're going to be flipping it to the other side and taking advantage of the rips and the dips. And folks, you guys remember this, right? This is code. This is binary code for that matter. And it is the most streamlined way to transfer data. So like this, I'm going to try and make it simple for you. And what we do is we break it down. If we take a snapshot of this, we can actually see the code broken down to O's and ones. That's the simplest it can be. I'm going to try and help you streamline your process when you are trading options, to know where to focus your eyes, because when you get over there in that option montage, it can be a little intimidating. There's a lot of numbers moving back around, kind of like this code is when it was on the video. But when we can stop it, break it down, take a deep breath, we can look at this stuff and really start to understand it. So with that said, what we're talking about with options, or anything in general, it's really hard to determine the price of these different underlyings. Let me try and get my pen over here, right? Because this is price and everybody says buy low, sell high, right? And it seems like such a simple concept. You buy a house and you've probably seen it. If you've been paying attention the last few years, well, they've gone up in value, right? So recently we've seen home prices jack up, but we've also seen recently, back in 2008, 2009, the housing crisis. Well, another thing we were hearing folks talk about are interest rates, right? And if interest rates are on the rise, one of the things that does is it sends home prices down. Why is that a correlation? Well, the reason why is, if you think about it, between you and I, let's just say somebody has $60,000, all right? So you're making $60,000 a year. All right. Well, the idea is when you are making a certain wage, you have a budget. And I'm not a financial advisor here, so please don't take this as financial advice. But the idea here is 25%. You should not spend more than 25% of your income on, I don't know why this seems like it's writing late, on your home, okay? So if you and I are looking at our budget, we can't spend any more than 25% of our income on our mortgage. Well, guess what happens when interest rates start rising? Well, you can only afford, let's say if 25% of your income is, what is that? $15,000. So basically, over the course of the year, I'm only really able to spend about, let's call it $1,100 a month for my mortgage, right? Because that's the breakdown. But when interest rates start rising, we have to pay more to that interest rate than to the house. So what happens is home prices actually start going down. So while we always think that home prices are going to go up, we do, in fact, see them go down. So when folks are saying, go out and buy a house, it's a great asset to own, some of us are looking at it like, well, yeah, but we don't know if it's worth that much, right? It's difficult to tell whether this pen is worth $50 or $200. It really depends on how bad somebody needs that, right? So while we've been watching these housing prices, we can see that these houses have been going back and forth. And to say that home prices are cheap right now, although, 6 months ago, we could have been saying that home prices were expensive, but then we saw them jump almost 10% in a couple of months there recently. And a lot of that has to do with folks are saying, hey, interest rates are going to go on the rise. I need to buy my house now while interest rates are low, because they understand this dynamic of if interest rates are going higher, I have to pay more to the interest than I can to the principal, right? So therefore, I can only afford a smaller houses, and that has a tendency to drop those down. I know I got a little bit on a tangent with the home prices, but what I want to talk about here is the fact, or what I want to drive home here, no pun intended, is the fact that when folks are saying and talking about prices, buy low, sell high, we don't know what low is and what high is, generally speaking. And it's such a novel idea. I mean, anybody can do it, right? If you look at hindsight anyway, the idea is you buy down here at this level and you sell at that level, because this is the low and this is the high, right? So simple. Actually, the only person I've ever really thought said this correctly was Joe Terranova when he wrote his book, and he said, buy high and sell higher. That makes more sense than trading stocks, because at the end of the day, sorry, I'm trying to slide in here, we don't often know where the high is, because on a pullback, we might have thought, like on an IPO, let's say it IPOs down here, how many people get in on the IPO? They see a rally and think, okay, well, pulls back, time to buy. All right, so now you buy it. Market shoots up, you think you're a genius. Comes right back down to your point, and you're like, oh, you don't do anything. Usually when it's trading at your price, you don't really do anything. You start seeing it go back higher, thinking you're a genius again, and then boom, what do? You puke, sell, right? Because it's a loser. And then the market rebounds back. So often we are caught in this back and forth as to whether or not something is cheap or expensive. And it's such a novel idea to say, all you have to do is buy low and sell high. It's not that easy, folks. Let me make that a little bit bigger. I'm sorry, I got the screen backwards for you. So for instance, we talked about the buy low, sell high, where you could actually be buying high and selling low and really not even understanding it. The idea, and some of you guys are probably much better chartists than me, and you will probably be able to point out flaws throughout this video. I never claim that I'm necessarily a chartist. I'm a novice, I guess, if you will, for 25 years. So anyway, we can find support and resistances after the market's traded. So then we can start determining where value is, really, if we can have a market, especially that trades sideways. A lot of times what do we have is bullish markets, right, where they're trending higher, and we see it constantly trading at an angle for those support and resistances. Those are a little bit more difficult to discern. And the same thing goes for like bearish markets. Finding support and resistance on those is a little bit more difficult because it ratchets down, if you will. Sideways markets are the easiest in my eyes, or at least for me, to find those support and resistances, because we can use like Fibonacci and stuff like that. Horizontal lines are easier than diagonal or vertical, for that matter. So idea is if you can have a chart and have it be consistent along the way, then you can determine value a little bit easier, right? We can determine that when the market gets down to this price level, price number, whatever, that is a buy zone, and then price, whatever number this is, whatever price that is, that would be a resistance area to sell. So, we can sometimes see it a little bit easier, at least where the overall market discerns value. That's not really what we think value is, but it's what everybody thinks value is. And that can change at a moment's notice, right? Think about the housing crisis. That changed at a moment's notice. Thing though about options is they will give us a tell whether or not the options are cheap or expensive. Now, I'm not talking about the specific underlying in general now. What I'm talking about are all of the options that we trade around that underlying. We can tell if those are cheap or expensive. And I'm not talking about length of time, saying looking out at 200 days and saying, wow, those are really expensive. And then looking at 2 days to expiration saying those are really cheap. Yes and no. You're buying time in that regard. Okay. So that is separated out from what we're talking about here. What I'm talking about is if we can separate the time out, the price never changes. But if we can see the price in the options change, we can actually tell whether those are cheap or expensive. Sorry, I'm trying not to get too far ahead of myself right here. But these options will give us a tell as to whether or not they're going to be cheap or expensive. And I'll show you how that works out. Because volatility looks like this chart. Volatility for a specific underlying has a tendency to trade sideways. It's a sideways trending market. And the reason why that is because every individual underlying has its own implied volatility or volatility coefficient. Meaning, if I'm looking at Kroger stock, its implied volatility for that stock is completely different than something like Tesla or Apple or a tech sector, okay? Consumer staples and tech don't have the same volatility coefficients. So we need to compare apples to apples and oranges to oranges. Meaning if I'm looking at Tesla's implied volatility, I only look at Tesla's implied volatility in the past and compare it to where it is now. We can't compare the VIX, which is an overall broader gauge of volatility in the markets, and say, okay, VIX is high, so this stock's option prices have got to be expensive. No, it doesn't work that way, because that one underlying might not be experiencing volatility right now, okay? So we want to look and narrow it down to an individual underlying to find basically those support and resistances, the same idea here. So when we're looking at the chart here, this is a chart of implied volatility. Now, it doesn't matter what underlying it is. It could be ABC or XYZ, or my pen doesn't want to work even after I click it. All right. So the idea here is we try and find support and resistances on this underlying. Now, sometimes it will break through, right? Even on the support and resistance. But I want to look at the overall support and resistance, and that's not a very straight line, but we'll get the idea there, right? So somewhere in between that area is around where the underlying goes. So we could say that this is high, right? High volatility and low. That's pretty simple. Well, one thing that volatility tells us in the options is for every increase of 1 percentage point, our options prices will adjust accordingly. So if implied volatility upticks 1 tick there, then all of my options for XYZ will increase, right? Without anything else happening. The underlying doesn't trade a penny higher, a penny lower. We don't move forward a minute in time. We just look at volatility. Do this, we know price of options went up. And the next day, if it did that and the underlying didn't move, it's still trading 100. Nothing happened. Well, guess what? Price in the options are dropping as this underlying implied volatility, this underlying implied volatility starts coming out, all right? Even if it's still at $100. Doesn't matter. If this starts coming out, those option prices are getting cheaper. And when this starts going higher, those options prices are getting expensive. So when the option have implied volatility up and around this area, let's call it 43, what do we know? That they are the most expensive we've seen in almost the past year. So that would be an opportunity to sell, right? Because we want to sell high and buy low. And if the volatility was down here at that time that we were looking at the underlying, we know volatility is low, so we need to be buying options because they're super cheap. It doesn't matter what the underlying is doing. It's all based, our strategy will ultimately be based on our directional assumption of this underlying. But I want you guys to be able to know intuitively before you ever even look at options to understand whether they are cheap or expensive. And this is the way to do it. You look at XYZ's implied volatility right now compared to where it's been in the past. All right? Pretty simple. Now some of you folks might be going, look at Wolfman, it breaks out every once in a while. Yes, it does. We're trying to capture the most of it, just like on support and resistance for stocks. You want it to kind of break through, and then when it comes back into the channel, then that's when you start getting on board, all right? Because then you expect it to go to the other extreme, all right? So you can wait for that too, especially if you're newer to trading. But if we stretch this all the way out for 3 years, you can see while it does break through every once in a while, and this is the pandemic, of course. Now, why don't I take that data point into my calculations for pricing? Well, yeah, this is the most expensive pricing has been in the last 3 years for this underlying. But that we call a black swan event, meaning that's probably not going to happen for another 5, 10, 20 years down the road. So I can't have that always in the back of my mind, knowing that it was a black swan event and it's not going to happen probably again. So I want to take that data point out. I want to try and get the ones where they are most likely going to touch, because then I know when we're really at extremes. So you can see that I didn't hit all of the tops or try to hit just a couple of them. I tried to hit almost as many as I could because I want more opportunities. Now, if you have a lower risk tolerant type of trading regimen, and maybe go a little bit further out to those extremes, okay? But I don't mind it piercing through a little bit on me for the support resistances, because that I know is cheap. I need to get involved when it's at those levels. Yeah, it could get a little more expensive or a little bit more cheap, but I want to get involved, and I know that they are relatively cheap or expensive based on looking at these type of charts. And you can see that this underlying, while some folks might be saying, hey, it's breaking out a lot, well, at the end of the day, over the course of the last 3 years, it didn't break out a whole lot. So those are pretty good, solid lines in the sand to go off of, even the support and the resistance. So you can see that this underlying, while its extreme might be somewhere up here around 0.9, I bet I could pull up a Tesla chart. This is another underlying I was looking at. This one's pretty close to that one, Tesla, but let's look at Tesla. And you can see Tesla's probably never getting as low. Okay, Tesla's very low is 43 there, and that would be our extreme, well, maybe not extreme, but that would have been our upper boundary of our resistance area for this underlying. So simply put, don't compare Tesla's implied volatility versus another underlying's implied volatility, okay? Because they are not mutually, they do not go together. They are mutually exclusive. So again, now we can start looking at charts and almost immediately tell whether or not they're expensive or cheap, right? Now, I wouldn't necessarily say that this underlying is super cheap. I'd take out this bottom here and try and, capture as many of these bottoms as I can. So if I draw a line like that and then kind of drew a line maybe right in there, yeah, I can see where it spikes out. But based on this, what does that tell us? I don't know how that came up, but it tells us that if this was the 50% line, then this is our sell zone and this is our buy zone for options. All right, I'm not talking stock, I'm talking the options, because I don't know where the stock price is right now. I don't know if the stock is bullish or bearish or market neutral right now. All I can tell you is that the options are cheap down here, right? Options are cheap. That's all we need to take away from this, all right? We know that when it's down here, our option strategy should be somewhat leaning towards the buying of options or paying a debit. And up here, we should be getting a credit or doing a strategy for a credit. And these are debits. Oops, debit. All right. So debit below, we want to do buying strategies, selling strategies above. All right. You can do defined risk strategies as well. Guys, if you're having a light bulb moment right now, smash that like button for me. I know some folks out there just had a light bulb moment because a lot of folks don't talk about this, how options prices are determined by this implied volatility at any given time. All right. So volatility drives the price more so than anything else. A lot of folks out there that are teaching how to trade options will talk about delta till they're blue in the face. All right. And the reason why is, I think the reason why is because they really just don't understand options. If you're talking about delta and how it affects your prices, then that's just remedial, and I don't think you're doing anybody really any justice. What we used to say on the floor is that delta was just data, okay? But volatility drives price, because while delta will tell you how much your underlying is, delta will tell you how much your options are going to increase or decrease in value based on what the underlying does. Volatility just says, hey, you know what? If the underlying doesn't do anything, I can adjust the prices however I want. Okay? And that's really what happens. Delta is finite, whereas volatility, if we're looking at the underlying, we don't necessarily know what's happening to volatility unless we're charting it. Okay? Like at the bottom of this one. Now, I did take this snapshot yesterday as the market closed, because these are the types of opportunities I look for when we have options, or when we have trades where we get to a top of a move and we start seeing these beautiful candles, like a spinning top doji like this one's going, where you get these at the top of a move. That to me usually indicates we're ready to roll over, but you need to have a candle that confirms it. It's got to settle below the previous day. So I would need a red candle to do something like that for this to be confirmed. I usually get involved a little bit early. A lot of things were going for this trade. We got a resistance that it failed on. We've got the 50-day simple moving average here, right? It failed that. So that would be something I would look for a trade to roll over. Now, obviously, you're out above the high of that wick. This would be you're out on a loser, okay? But I would be getting involved usually on the candle. Folks, wait for the confirmation if you are newer to trading on swing trades like this. But what I can tell from Intel is that it has kind of high volatility, but it's right there at the middle, right? I told you this is the sell zone and this is the buy zone, but when it's right up against this little area, I mean, I don't know if volatility is going to go higher or lower, right? If it goes lower, my strategy of selling options would work. But if I had done something where I bought it, then it wouldn't have. So when you're right in the middle here, it's a little bit of a gray zone. So one thing we can do with options is neutralize all of the ill effects that happens. Theta, that thief in the night that comes and steals your premium. Delta, we can take advantage of. Volatility, we can neutralize. So that is the beauty with options, and especially the synthetic long and synthetic short, because we can neutralize those when we don't really have a real strong understanding of where we think volatility is going. We just have an idea, if you will. So before we get going too far, don't worry about the Greeks. We're going to find out ways to make these super easy. Now, one of the things we talked about a minute ago was delta, right? So delta is basically tells us the rate of change to an options premium, okay? Delta is change. So the rate of change. So if a delta is 45, it means if the underlying moves higher by $1, then our premiums increase by 45 cents. But what I want you guys to take away from this is delta is data, all right? So when we're looking at delta, I like to look at it as if it's data. And it tells us the probabilities of being in the money. So let's go back to that delta of 0.45, right? We got a 0.45 delta. That means it's a 45% probability of being in the money by 1 penny, folks. That's just 1 penny. Being in the money by 1 penny at expiration, right? But 2 times, let's go to, what happened? If we look at it as 2 times delta equals your probability of touch. All right, so probability of touch. So if I've got a 45 delta, well, 2 times the probability of delta is 90, right? So I got a 90% probability of touch, only a 45% probability of being in the money. So when you're looking at these probabilities, the idea is when you're buying out of the money options or trading out of the money options, you know you got small probabilities of being in the money, but 2 times that probability is the underlying will trade your strike during the life of that option. All right. So that is delta. And then we have gamma. And remember what, back to delta. Delta is that increase in the first dollar, right? So if the underlying moved up by $1, our premiums increased by 45 cents. Another thing we have to think about, if the underlying goes down, what happens to delta? Well, a negative plus a positive makes it a negative. So it would be a negative to that position. But gamma just talks about an increase on dollar. I'm going to say dollar number 2, all right? Or dollar number, whatever. So on the second dollar, gamma goes with delta. All right. Gamma goes with delta on the second dollar. So if gamma is like, say, 5 cents, that first dollar number 1 we talked about, it increased by 45 cents, right? Now we're looking at dollar number 2 over here of the increase. I don't know why that thing's coming up. Now gamma goes with delta, and it would be 50 cents on the second dollar. All right, so gamma goes with delta, pretty simple. And then finally, we've got the thief in the night that steals your premiums. His name is theta. All right, so theta is the thief in the night. Theta is always negative. It's always negative. Why? Because you can't go back in time. So the only way to make theta positive is what? To sell. If you sold and theta is negative, it'll help you out, right? So theta is more aggressive the closer and closer to expiration. As a matter of fact, further out in time, we see theta not do a whole lot, and then basically it drops off of a cliff inside of 7 days to expiration. It actually is more of a better line there. And we look at 35 days to expiration as being the real sweet spot for selling. This is your sell zone because theta is really aggressive. And then your buy zone is outside of 70 days. Because outside of 70 days expiration, theta doesn't even know you're alive. Well, he does. He's taking pennies though. Whereas the closer and closer to expiration, starts taking fistfuls. So theta is the thief in the night and starts ramping up closer and closer to expiration. He doesn't want you to get out before he takes all your money. And then finally, we've got Vega. Folks, this is the one. Vega is implied volatility. Right? We've been talking about implied volatility all the time. Vega says it's on an increase of 1 percentage point. So that's why I'm saying Vega is more important. Delta has to move, has to have the underlying move for it to do anything. Gamma has to have the underlying really move for it to do anything. Theta is constant. Every day that goes by, he steals money. So, that's not really doing anything that we can, other than take advantage of selling and buying, right? But Vega is a different beast. It's the one that tells us if prices are cheap or expensive. This is the key to price. Because you can imagine if volatility starts increasing, one tick, we could see that prices would start really jacking up. Let's take a real life example here. So if Intel is the one that we're looking at for this trade for a bearish move, what is delta? Delta tells us the rate of change to the option. We can see delta is negative on the put side because everything's assuming an advance, not a pullback. So an advancement would be a dollar move higher, right? Well, if the underlying moves higher by $1, then a negative delta would decrease the value of these options, right? And if you think about it this way, if it goes down, well, a negative plus a negative makes that a positive to your position, right? So that would help increase it. So delta, we can see, is just your probabilities. Probabilities in the money over here are much higher than the out of the monies. Why? Well, because it's the probability of being in the money. Delta tells us the probability of being in the money. And the ones that are already in the money are a much higher probability of being in the money at the end of the day. So delta is right around 50 at the money, and then in the money it starts getting bigger. Out of the money it gets a little bit smaller because out of the money probabilities are less likely to occur, right? And then we look at gamma. Gamma goes with delta on dollar number 2, right? Theta is our thief. You can see it's always negative. Theta is always negative across the board. We can't stop that thief stealing our money. We can take advantage of it, but we can't stop it. And then finally, Vega is the one that we are really concerned about today because that one determines price. So even if XYZ doesn't move at all and volatility increases 1 percentage point, if we get an increase of 1 percentage point, over here is probably proper. Increase here of 1 percentage point to make it clearer for folks across the board, 1 percentage point increase. Well, then we would see these premiums jump into not the delta, but to the premiums and the corresponding line. So volatility would increase these premiums there, and volatility would increase these premiums there, and they would increase these premiums on this side as well at the same time. So if we get a volatility increase of 1 percentage point, all the premiums go up by their corresponding Vega. It doesn't matter if it's in the money or out of the money. That strike will increase by its corresponding Vega. 1 percentage point increase increases prices. 1 percentage point decrease decreases those prices. All right. So these are the numbers we're looking for over on those charts, and we're looking at because Vega is, like I said, just a fancy word for implied volatility. So while we're looking for this number to increase or decrease, we have to know if that number is high or low, though, right? Because by looking at that price, I don't know if it's high or low for Intel. I know it's low for Tesla maybe, but that doesn't help me out here. So I need to figure out if this is low or high for that underlying. We already determined it was right in the middle. So if it's right in the middle, I don't know if volatility is going to go higher. I don't know if volatility is going to go lower. That means what? If I don't know what volatility is doing, I don't know what price is going to do. So I need to neutralize it. All right. And if I neutralize it, that means I buy one and sell one, and I can pretty much lock that out. It won't really negatively affect me. Now, another thing with this underlying, if you wanted to take advantage of a quick move or a long-term move, options can play that out. maybe you wanted to be really aggressive and say, you know what? I want to short this like I would short a stock. I want dollar for dollar on the downside. I want that risk reward. Options never give it to me. Well, most people don't tell you how to trade the options that way. But I'll show you here in a moment. We're going to be building a synthetic short, which actually acts just like the underlying. So what we look at this as the underlying, and if I were going to short this underlying, right, I would sell it before buying. All right. That means I would get short at 48.27. And if it goes down to 47.27, I make $1. All right. I lose $1 if it goes up to 49.27. All right. Just like the underlying. So as the underlying increases or decreases by $1, that means the underlying, because we're buying and selling 100 of these, it's 100 delta. Okay. Or 1. Meaning if the underlying moves higher by $1, my position increases by $1, that's 100 delta, and vice versa. If it goes down, I lose, or it adjusts by $1. That is delta. So with options, you saw me talk about the ones that are in the money and out of the money are the ones, the in the monies are a little bit higher, ones that are out of the money are a little bit lower. Well, think about this. If I were to go in here, oh, another thing before I get on with this, you can see theta is much more aggressive inside that 35 days to expiration I was talking about than outside that 35 days to expiration. You can also see that Vega is going to affect further options more than the nearer options, okay? So Vega affects the further ones, theta affects the nearer ones. And remember, if you got that light bulb moment, smash the like button for me. All right? So what we want to do here with this one is make it act like the underlying. Well, the underlying is not affected by volatility and price, right? So we need to get rid of volatility. Now, if I go in here and I sell a call and let's say buy a put, what happens? And I'm going to go right at the 50 because it's a little bit easier. If I sell a call, this delta becomes negative, right? The gamma also becomes negative. It'll add in there. The theta becomes a positive for me, right? And the Vega, because I sold it, is negative. Now, on the flip side, on the puts, I buy positive. I buy, which is positive, a negative delta. That's still negative, right? So that is negative. That positive plus that negative, the gamma goes with the delta, and then I buy the theta. The theta is going to hurt me, right? So that's a negative to me. And then I buy a positive volatility on the puts. So that's a positive to me. So what happened here? I've got the delta is negative plus a negative, right? The delta is negative across the board. So those add together. I've got 43 and 57. So those two go together. Sorry about that. Those two go together. So I've got 43 negative deltas, right? Because it's a sell of a call. And then I've also got the negative 57 deltas. So what does that equal? 100 negative deltas, right? Negative deltas on the call, negative deltas on the put. I add two negatives together, I get 100 negative deltas. That means if this underlying goes down by $1, my position will benefit by that dollar, okay? So we've created a synthetic short without all the friggin' headaches that you get from going out there and shorting. If you ever shorted, you have to come up with borrowing costs. You have to pay the dividends. It's a headache, all right? And sometimes you can't even borrow this stock. So with this, you can build it out so that your underlying is trading, or your option strategy is trading just like your underlying. And this would be one contract at one option contract. Because folks, remember, one option contract is equivalent to 100 of the underlying. And the reason why that is, it's kind of like an ETF where every option strike has 100 stock in it to convert, all right? If you're getting rid of it or buying it. So That's why it's 100 delta. And that's why we would only want to do one, is because it's got an equivalent of 100 embedded. Now, let's take a look at this Intel trade. I went with those 50 strikes. One of the things that I want you to know with this is because we have completely eliminated all these option things that negatively affect us, we can go further out in time and it's still the same trade. So if you can go further out in time, you might as well give yourself enough time to be right. Okay. The trade will cost you the same amount with 22 days to go as basically 300 days to go. So you want to build this out properly. Again, we went in here, looked at this strategy and sold the call here. I'm selling a call here. So I collect $2 and let's call it 20 cents. And then I buy a put here, which means I have to pay out, pay $4. Offsetting those, I get right around $1.70. Okay. It's $1.80 from where I priced that out, but right around $1.80. That has to then, if you're paying a debit, subtract from this price. So $1.70 minus $50, I get $48.30, right? That means I'm getting short. I get short synthetically the stock at that price. And look at that. It is right in line with where the underlying is currently trading. So with this strategy, another layer of security on pricing is that you know that if you're getting involved in this strategy, you should be able to price it out exactly where that underlying is trading and get it. As a matter of fact, you can actually sometimes get short above where the underlying is trading, where it hasn't even traded, or get long below where the underlying is trading or has never traded before. So that is a product of options that is another benefit, is you can get outside of those wings. And I'll show you, as a matter of fact, I did an example when I was looking today. Thought I have an example here somewhere. Maybe it's this one. Oh, where'd it go? Oh, it was my screenshot. There it is. So for instance, I pulled this one up today when I was looking around. Kroger trading $56.71, built this out. It got a credit. So when you do a credit, you actually have to add that in on the short. And you can see $55 with a $1.77 credit. That gets me at $56.77. This underlying is trading $56.71, $56.72. So 5 cents above where that underlying is trading. That's pretty good. I'll take that. How often have you ever sold a stock above where it's trading? Not very often. Getting traded through there. So you can see those are products. With this, doing it after the close, wasn't able to build it out to where it was working that way. So again, if we go out in time, further out in time, now I'm out to the July. The last one was the June, right? We were June here, $1.70 credit, or sorry, $1.70 debit. Go out to the July, we can see $1.70 credit. Now, same prices, everything else. Another thing we can look at is how it reacts against the underlying. This is a representation on the Analyze tab. The purple is the underlying, the blue is my trade, and you can see that the underlying is trading in tandem with my strategy. If it goes down, I make $1. If it goes up, I lose $1. Dollar for dollar, the same trade here. And then further, if we go, we can check this trade out legit and see what the Intel July trade. I want to go a little bit further out. We showed the June and the July trade, same price. I want to show you even further. $1.75 credit. You're going to have to put up in a margin account. This isn't in your IRA. Your IRA, you're going to have to define the risk. And in a regular account, you probably have to pay more. This is a margin account, which is going to give me about 50% less margin on this trade than I would have to do if I went out and shorted. And if I go out and short, I have to get all those other insurances and everything, assurances. So we could see 1,200 there. And then if I go further out in time and go out to the January, you can see these are, sorry, I thought that was the June. Where's my January? There's the January. The January, you go out further, you can still see the first one when I built it out. I used the June 44 delta, 57 delta. So anybody notice anything about that? That's something I wanted to talk about with the last one. This one's 101 negative delta, so a little bit better than doing outrights as well. And that one was the one where we were able to sell it above. So I got an extra stock, and I got to trade above where the underlying was traded with that extra stock. A kicker for me. Nice little bonus. But you can see when you go out to even the January, yeah, it's a little bit more expensive, but not, I mean, that's negligible altogether for a trade that's 300 days out, right? Didn't have to put up a whole lot and can trade this out. Now, if you are in a IRA or something like that, you want to define this strategy, I would look to go out to around the 16 delta, all right? The 16 delta is where I'd want to define those calls to the upside. So for instance, if I was doing this underlying, the 50s, I would try to define the risk at 57.5, buying that 16 delta, all right? I would not let it go much further than that. Let it trade, you know, put it aside. But what I want you to take away from this is if you're thinking you're going to save money by coming in closer with this strategy, it's not going to happen. It's all a product of the margin. And you can go way out in time. I mean, as a matter of fact, by going out this 200 extra days, I paid $200. That's pretty good for that trade. And I can get in right where the underlying is trading. You guys have any questions so far? Before you go, smash that like button. Oh, hey, and the other thing is I do spot the trade videos and talk about my trades. Those are really unannounced. Like I made a mistake today, came in a little bit early. Hopefully you folks have your little bell lit up right next to the subscribe. The subscribe, you know, tells you when there's a video. The bell says, hey, dude's on right now going live. So make sure you guys have the bell lit up as well. All right, that's all I got so far. This is my offer for you guys. I'll throw this over in the chat window though right now so you guys can take advantage of this. We are almost full on this. Every time we start one of these courses, I try to get some members in there so that you guys can have access to me. I want to make sure everybody's clear of concept. So take advantage of this. Like I said, the class is almost full here. You get to all the courses I have. I even go back and talk about those with you. You can call me up. If you have any questions, comments, or anything else, reach out to me in email. You have unfettered access to me. This says it's during working hours, but I bend the rules a little bit for you folks. And for $97, literally, if you guys had a light bulb moment today, it probably saved you $97. 97 cents is what that would be in an option. And that's it. Thanks, guys. Again, here's your link. You can reach out to us at 310-598-6677 or trading@protraderstrategies.com. I do appreciate you all, and thank you all for joining. If you guys made it all the way through this, smash that like button or take that. Take it easy. Bye for now.